and the Fed is aware that it's going to have to start QE again at some point. Before that happens, there's going to be a financial something, monetary something. Nobody knows exactly what, and then they're gonna do QE again, and then I think gold and silver should just go up from there. I don't think there's going to be a financial doomsday. I don't think it's really possible because in the end, there's always something liquid to trade.
Right.
If there's no liquidity, like the worst that could possibly happen is that there's a dollar crash and the government, all governments all over the world say you are not allowed to trade gold and silver. If you do that, we're going to cut your head off. Right?
Right.
That would mean there's no liquidity, because if you try to use liquidity, they would kill you.
When quantitative easing, QE, resumes, likely in response to financial stress or Treasury pressure, it almost always boosts both gold and silver prices. Historical cycles, like QE1, saw gold soar approximately 50% amid rapid balance sheet expansion. Recently, analysts expect the Fed to reintroduce QE by autumn, sparking a fresh precious metals rally. As liquidity floods the system, gold benefits most immediately, with silver typically following, sometimes more dramatically due to its industrial leverage. The worst-case scenario would be a dollar collapse, with global governments banning the trade of gold and silver. Rafi Farber, market specialist and commentator, argues that a full-blown financial doomsday, where the division of labor completely breaks down, is highly unlikely. Even in a severe dollar crash, governments wouldn't be able to prevent people from turning to real liquidity, such as gold or silver, for long, because enforcing such bans would require funding, something collapsing governments wouldn't have. According to economist Rafi Farber, quantitative easing hurts currencies and prompts people to rush to buy gold. In 2016, he predicted that gold would continue to rise on the back of the fourth round of QE undertaken by the U.S. Federal Reserve. On June 14, 2018, when the ECB announced its plan to phase out QE by the end of 2018, it also stated that the European economy was still soft and that interest rate hikes would not take place until March 2019. This news prompted the gold market to respond positively on that very day. Therefore, we can infer that while QE is beneficial for the economy in terms of GDP growth during a crisis, it's not conducive to currency stability. It's both these reasons that spur the rise of gold prices at these times. Losing trust in a currency starts slowly but can unravel rapidly, much like a bank run. Just as people lost confidence in individual banks during events like the Great Depression or the collapse of Silicon Valley Bank, a sudden loss of faith in a central bank could trigger a fast-moving crisis, potentially unfolding within hours. In response, central banks may print more money, but when that fails, people will likely turn back to gold, silver, or metal-backed systems. For protection, the speaker recommends different gold-silver allocations based on wealth. Wealthier individuals should favor gold for stability, while those with less capital should prioritize silver for liquidity and daily survival during the endgame transition. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
In the end, there's always something liquid to trade.
Right.
If there's no liquidity, like the worst that could possibly happen is that there's a dollar crash and the government, all governments all over the world say you are not allowed to trade gold and silver. If you do that, we're going to cut your head off. Right?
Right.
That would mean there's no liquidity, because if you try to use liquidity, they would kill you, and the dollar doesn't work. So that would be a full breakdown of division of labor. We're talking zombie apocalypse, especially in the big cities. But I don't think that's possible, because the only way for governments to be able to successfully tell you and force you not to use gold and silver is if they are themselves are funded, because they need a lot of money to enforce those draconian evil rules, and they're not going to have it.
Right.
So it's a self-balancing act. Once the government collapses, you can trade real liquidity. It just takes time for that liquidity to get into the system. And because it's natural liquidity, it would only go to where the actual demand is, instead of demand created by the inflation of the money supply, which is where money's been going until now. So you're going to have something like not a zombie apocalypse, but you're going to have a breakdown in, let's say, real estate, house flipping, trading, these real estate firms. Everywhere I go, it's like, oh, what's he doing now? I'm with my family and on a hike in North Carolina. I'm like, I haven't seen some of these people for a long time. It's like, oh, what are you doing now? Oh, I'm in real estate. What are you doing now? Oh, I'm in real estate. I'm like, I don't even ask what the hell. Like, what does that mean? You're in real estate. So everybody's in real estate. So the people that are in real estate are not going to be in real estate. The only reason they're in real estate is because the prices keep going up and they keep flipping. Right. And then they shave some of that off for themselves. But once the prices go down, the only way you can be in real estate is by shorting. And I don't think anybody that I meet that's saying I'm in real estate is doing that. So they're all going to go away and they're going to have to do something else. And there it's going to be really tough. They're going to have to fit into a real economy somewhere. So no, I don't think there's going to be a zombie apocalypse. I think it's going to be worse in the big cities and better as you go out. And it's going to be the best in the country. And for stackers who will, collect whatever capital is left in the big cities and reorganize from there. Losing trust in currencies is a gradual process, but then it's quick. Losing trust in currencies is what we say to describe the front end of what's happening. But what's really happening on a banking side, right? A bank run, let's say like they had in the Great Depression, that would be losing trust in a local bank. And they lose your currency, and therefore you lose all your purchasing power. Losing trust in a currency is basically the same thing, except it's losing trust in a central bank. So how fast can losing trust in a central bank concretize itself, become material? Well, how fast do bank runs happen? Right? We saw with Silicon Valley bank runs happen in about an hour.
Yeah.
How long was it? It was like there was an announcement on the weekend. And then they did it on the weekend because they wanted, a 24-hour breath to take before everybody went to hell.
Right.
So how fast could trust break down in a central bank? In hours. It's not gonna take long once it starts. It's gonna be almost immediate. Then what they're gonna do in response is they're gonna print even more money. But when that doesn't work, there's nothing else to do except go back to metals. Or some metal derivative. And that's what we're going to see. I don't know how long it's going to happen, but it's not going to take long once it starts. I would want to be somewhere, and it depends on your spending taste. How much, what's your lifestyle like? For me, I don't spend that much money. I'm comfortable with saving and, just meeting my, not basic needs. I like a little bit of luxury, but I'm not, I'm not going to buy mansions or anything like that. For me, it would be enough to get through the end game for my family. So probably maybe 30-40% silver and the rest gold, because I don't want the rest to move so much. For a billionaire, it would be probably mostly gold, and enough silver to get through a year. So let's say 90% gold, 10% silver. For someone who has very, very little capital and maybe makes a few $100s extra a month, then it would probably be 90% silver, 10% gold. I mean, it all depends what your situation is. I just say as a general rule, if you have enough liquidity and you want to be able to sleep better, then have more gold. If you're worried about getting through the end game and you're worried about having enough liquidity to sustain yourself and your family as things get really crazy, I'd say get silver if you don't have any first.
Yeah.
So silver would be more important in the immediate term. For anything extra, go with gold just so you can have some steady purchasing power that won't change really that much.
Rafi Farber highlights that since the U.S. debt ceiling was raised in early July, the Treasury has raised no net new funds, and its general account at the Fed has been steadily declining, currently under $300 billion. By September, the Treasury plans to raise that to $800 billion, effectively draining $500 billion from the banking system. This could trigger a liquidity crunch, as banks may struggle to absorb that much without instability. Elsewhere, platinum has broken out of a long-term trend line, potentially aligning with a 15-to-1 silver-to-gold ratio. Japan is nearing hyperinflation, especially in food prices. A silver exploration company, Silver 47 AGAF, is performing in sync with silver prices and may appeal to U.S.-focused investors. Lastly, the Fed appears to misunderstand reserve needs. A recent claim that $2.7 trillion in bank reserves is ample contradicts actual repo market activity, suggesting critical gaps in monetary system understanding or intentional misinformation. Let's recall the interview.
That was just an accounting gimmick, because what they do with extraordinary measures means lying about the debt until they count all the money they've spent while the debt ceiling was suspended. They can count that as debt once the debt ceiling is raised, but they've already spent that money. It's just an accounting catching up with the reality of the past, however long they've been doing extraordinary measures for. I don't know exactly how they work, but it's basically lying. That's what it is.
Oh, geez.
So that $450 billion, it's not like they actually raised the money. So what I'm looking for is the Treasury to actually start raising the money, and you can tell that directly by how much money is in their bank account. And they don't have a bank account like you or I do. They have a bank account with the Federal Reserve. So all the money that they have is not part of the monetary system. I think this is just wind. I'm outside right now, and the wind is blowing the leaves, and it just rained. So like it's now something around 300 billion. And before the debt ceiling was raised, it was even more than that. So they're still spending money net, and that means they're spending money into the banking system. And when they spend money into the banking system from their bank account, which is outside the bank system at the Fed, that adds to bank reserves. And the reason it adds to bank reserves is because the bank system is already so stuffed with cash, it has nowhere to put it has nowhere to put the money except back into bank reserves. So when they start raising the money, they start taking out, they start sucking out of bank reserves into their bank account, and that should trigger a financial crisis, because right now there's about $3.4 trillion available in bank reserves, and $2.8 trillion being traded every night in the repo market with bank reserves.
Right.
So when they start raising money, that 3.4 trillion is going to go down to about 3 trillion, because they're looking to raise about they want to get the balance back to about $800 billion in their bank account, and right now it's at 3, so 8 minus 3 is 5, so $500 billion. So if you take 3.4 our reserves are now, you take away 500 billion, you're at 2.9, and by then the repos should be around 2.8, 2.9, and then you're going to get stuck somewhere. So that's what I'm waiting for. And once that happens, I don't expect silver and gold to go up immediately. I expect them to go down very strongly. Silver very strongly, gold less so. And then once the Fed realizes that they have to start creating more bank reserves, then there should be a slingshot. So that's what I'm waiting for. That's what happened in 2019, but nobody was expecting it. And I think we just had, there was an article out in Bloomberg about Scott Bessent, the Treasury Secretary, asking banks how much bills can the Treasury sell without some kind of bad thing happening. So he clearly doesn't know exactly where the fault lines are, but he's aware that they're very close somewhere. And the Fed is aware that it's going to have to start QE again at some point. Before that happens, there's going to be a financial something, monetary something. Nobody knows exactly what. And then they're gonna do QE again. And then I think gold and silver should just go up from there.
What does a true financial doomsday scenario look like to you?
Well, financial doomsday means the division of labor breaks down. The only reason the division of labor would break down, and it's going to break down to a certain extent. I mean, we saw that in 2008, it broke down to a certain extent, which means that certain industries went out, went away, and certain other industries got even bigger, like real estate and financial speculation and banking and that kind of stuff. I don't think there's going to be a financial doomsday. I don't think it's really possibly happen, is that there's a dollar crash, and the government, all governments all over the world say you are not allowed to trade gold and silver. If you do that, we're going to cut your head off. And the dollar doesn't work. So that would be a full breakdown of the division of labor. We're talking zombie apocalypse, especially in the big cities. But I don't think that's possible, because the only way for governments to be able to successfully tell you and force you not to use gold and silver is if they are themselves are funded, because they need a lot of money to enforce those draconian evil rules, and they're not going to have it.
Right.
So it's a self-balancing act. Once the government collapses, you can trade real liquidity. It just takes time for that liquidity to get into the system.
The return of quantitative easing, QE, appears more likely as fiscal pressures rise and liquidity dwindles. While QE may temporarily boost financial markets and GDP, it fundamentally weakens fiat currencies, thereby increasing investor demand for genuine assets, such as gold and silver. As the U.S. Treasury prepares to drain $500 billion from the financial system by September, a liquidity constraint might serve as a stimulus for further QE, perhaps causing a dramatic shift in precious metals. The argument for strategic gold-silver positioning has never been stronger. If a severe liquidity crisis develops by September, are you well positioned to profit from a rapid surge in metals? What would happen to your portfolio if central banks fail to restore trust and metal-backed systems resurface? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up and don't forget to subscribe to stay informed.